Thank you to Hideki Kinohata of Still Capital, who along with Chris Joe of Stillbrook has made a Sohn pledge today. So to the audience members, that's a reminder to give generously to the Karen Leung Foundation's efforts. And we just heard from Hideki Kinohata on his pick for Sohn, that's Topan Printing. This says Japan's digital transformation certainly has been given an impetus by Prime Minister Suga, as we're seeing a structural shift in consumer and business behavior in Japan that has also pushed companies like Ricoh to embrace the change towards going digital. And with that, we now are shifting gears to focus on China with Jeffery Gao, founder and CEO of J-Stone Capital, who mainly invests in Chinese property sector. Now, he comes with 15 years experience in investment and research on the property space. So let's hear from him now on his Sohn bet for today. Jeffery?
Good morning, everyone. My name is Jeffery Gao. I am the founder and the CIO of J-Stone Capital. Today, I want to present to you the market overview of China property management service industry, which is one of the opportunities in China property ecosystem. First of all, let us look at the China property itself. Property is a key part of China economy. As many of you may know, this is the biggest industry in China. The annual property sales reached RMB 17 trillion last year. And according to PBOC survey, the housing assets accounted for more than half of total wealth of China's urban households. So this is the biggest one for no doubt. Government is issuing a lot of policies to foster a healthy development of this industry. Therefore, we expect this industry will experience a slower growth, but the whole sector will see deleverage. In the next few years, we are going to stay at a pretty high level of annual sales. Last year, we sold 1.5 billion square meter residential last year, and this number may stay flat over the next few years before we see sequential decline. If we view China property as a platform, you will see a lot of opportunities. So many of the developers tap into the new business, but they are all based on the China property business. So one of them is property management service. The second one is property management for the third party, which is more of a light asset model. So they charge commissions for developing projects for the third party. Some of them, like Langfo, like Paolong and Season, they build a lot of shopping malls. They invest into the office and shopping mall retail buildings. Because in China, the REITs is not yet too mature, so they are still holding the assets. But going forward, when the REITs is more matured, then they are going to spin off. Some of them doing urban renewable projects and city operation. Some of them doing tourism and cultural theme parks like SohnX, overseas Chinese towns. Some of them doing long-term rental apartments like Vanke, like Langfo, and China ICE. All these diversification is to see a sustainable growth based on the China property development in a decades. So it's a way of transformation. If we go upstream, we see relevant industry of waterproof, paint, constructions. If we go downstream, we see many companies are doing furniture like Sofia, even agent brokers like Baker listed in US. So this value chain hidden a lot of opportunities. Today, we are going to talk about property management service industry. This is a very big and yet to consolidate market. Total square meter area under management end of last year was 27 billion, and it is still growing. As we mentioned earlier, each year we sell more than 1.5 billion square meter, so they are translating into the GFA under management going forward. And the top 10 developers or the service providers, they only account for less than around 10% of the market share, so this is yet to be consolidated. In China, many of you may know that it's different from Western countries. We have wards for many of the large-scale communities, and they are all concentrated in big cities, so which provide a lot of additional business, namely value-added service. So this business actually came to a few different characteristics. They are of positive operating cash flow. The profit is non-cyclical, and the business is light asset model, which are favored by many of the investors. Last year, the total market size was 1.2 trillion RMB, only looking at the management fee, excluding the other value-added service. And this industry is still growing to around 1.7 trillion by 2024. So besides the traditional projects they are managing, residential, office, and shopping malls, many of the service providers also managing public areas. They are managing city service, which are traditionally managed by the government. Now they hand over to private companies to manage. And besides the basic service they provide to the community residents, like cleaning and security, they do a lot of value-added service to property owners and to non-property owners. A few good example is housekeeping, childcare, after-school education, and new retail. Policy is quite favorable to this industry. So we got strong support from central and local government. At the beginning of this year, the central government, 10 departments issued policy to support the development of this industry. So they recognize the property management service critical social role in improving residents' living condition or living quality. Also, they encouraging these companies to provide value-added service like healthcare, like elderly care, nursery and children education, housekeeping. All these will be a big portion of their income going forward, in addition to the basic management fees. According to our data, top 10 service providers, 35% of the income coming from value-added service. During the meantime, the capital market is developing quickly. Since the first listing in 2014, namely Color Life, by now we have 45 stocks listed in Hong Kong and China Stock Exchange. And the total market cap is around Hong Kong dollar 1 trillion. With more names to be listed and they are growing, we believe the sector will grow into Hong Kong dollar 1.5 trillion industry. Next page come to our stock recommendation, namely SohnX Service 1516.Hong Kong. This is a subsidiary of SohnX China, one of the biggest developer in China. So we believe this is going to be the key player in this industry with rapid growth. So the core profit last year was 620 million RMB, and they will grow to 3 billion in 2023. And the GFA under management end of last year was 135 million square meter and will grow to 450 million square meter in 2023. These data showed more than 70 and more than 50 CAGR growth in these 3 years. So why we have such a high conviction in the rapid growth? First of all, because the visibility is actually pretty high. On top of the 135 million square meter they are managing, they already got a reserve GFA of 129 million square meter contracted. They are going to translate into revenue when they go down to GFA under management. In addition, the parent company still have another 127 million square meter uncontracted. So only from parent company's contract sales, the GFA under management will be tripled. And secondly, they got strong support from parent company. And the parent company last year was number 4 developer in sales, and they sold 575 billion in total. And they are still growing. We expect the total sales will reach 1 trillion sales in 2023 and 2024, and make SohnX China to be the top 3 developer in China. In addition, the parent company is the largest operator of cultural tourism theme parks, as well as the convention center in China, which will diversify its products under management. The second thing I want to mention is SohnX Service is set to inherit the DNA of M&A because the parent company got a very strong M&A track record. In 2019 and 2020, 30% to 50% of the GFA land banking coming from M&A. One real example is SohnX China acquired Zhangtai Group in April, which is the largest developer in Guangxi province. And then SohnX Service acquired 25 million GFA from this acquisition. And the third thing to mention is the GFA under management are mainly in Tier 1 and Tier 2 cities, which translate into higher property management fee per square meter per month. So it was $3 versus top 100 peers $2. So it's 50% higher. Why this is important? Because this means higher average household income for the areas they are managing, better affordability, and the residents' more willingness to pay for higher quality service. So this company have M&A DNA, support from parent company. Also, they are tapping into third-party market expansion, as we mentioned here in the charts on the left. Also, this company have higher income residents people, so they can provide a more community living service. Last year, only 3% revenue coming from community living service, and peers had around 14%. With the increase of the community living service percentage, which have higher gross margin of 46 versus branded gross margin of 27, all these will contribute to higher earnings growth. The company's management's already guiding pretty bullish on earnings. Double earnings this year, 70% growth next year, and 30 to 50% earnings CAGR thereafter. But we still expect the number will be beaten in the next 5 years. So all in all, this is an industry leader, which may justify a valuation premium. We still see potential upside surprise coming from the management guidance, and this company still give you attractive valuation, trading at 27 times next year PE. But if you look at the PEG, it is only 0.6 times. The catalyst would be the potential M&As coming in the next quarter or the quarter after, and also MSCI China Index inclusion, which will happen next week. What about the risks? One is about the cost pressure from several hack, because in the cost structure, 60% coming from labor cost. Another thing is more competition from competitors, because we expect more list costs going forward. We stop here. Welcome for any questions.
Thank you to Jeffery Gao of J-Stone Capital for presenting his Sohn pick, that is SohnX Services, which listed in Hong Kong in November. Now, as Jeffery pointed out, policy support from cities like Beijing and Sichuan, they've been a boon for property management players like SohnX Services. The pandemic also is a big factor. How has that altered their services?
Actually, you probably noticed that last year in China, there's an outbreak of pandemic. So many of the property management service companies are under huge pressure because they need to handle the daily cleaning security. They also need to handling the pandemic and the check of the community residents. But they're actually doing this well, and this is well recognized by the central government. Therefore, the central government and the local government view that these service providers can contribute a lot to the living condition and the quality of these community residents. So a lot of supporting policies. One of the key policies is they allow the local government or local community have more flexibility in the pricing mechanism. So previously, it's really difficult to hike the price of the property management fee. But this is now more encouraged by the central and the local government to issue or to negotiate a more favorable mechanism to hike the property management fee, which will improve their margin going forward.
All right, Jeffery, thank you for your insights on China's property management services sector, which is enjoying valuation premiums over traditional developers, given the upside potential there. Thank you to Jeffery Gao of J-Stone Capital. And up next, joining us from Shanghai is Rebecca Xu, partner of Paisia Investment Management. She's also the fund manager of the Paisia Oriental Fund, which is a China equity long-short fund focusing on secular growth as well as disruption. Now over to Rebecca.